Hello everyone, welcome back to our channel. I'm John Werner with Mortgage and Credit Pro. Today we're diving into an important topic that affects everyone, whether you're buying a home now or just planning for the future. The difference between the federal funds rate and mortgage rates. Even though these rates sound similar, they play a very different economic role. Understanding how they work can help you make a smarter financial decision in the future. So let's break it down in a way that's easy to understand. First, let's start with the federal funds rate. The federal funds rate, often called the Fed rate, is an interest rate that banks charge each other when they lend money overnight. Imagine if two friends loaned each other lunch money but wanted a little extra back the next day. Well, that's sort of how the Fed rate works, but on a much larger scale. The Federal Reserve is like the country's bank for banks. It sets this rate to help control the economy. If the Fed's rate is low, banks can borrow more money cheaply, making them more likely to lend money to businesses and consumers. This helps the economy grow because people can spend more. But if the rate is high, borrowing becomes more expensive, which can slow down the spending and helps keep inflation in check. Now let's talk about mortgage rates. A mortgage rate is the interest rate you pay when you borrow money from a bank to buy a home. It's like a rental fee for borrowing the bank's money. When you get a mortgage, you agree to pay back the loan for a certain period of time, usually 15, 20, or 30 years. The interest rate determines how much extra you'll pay back on top of the loan amount. Many factors, including the federal funds rate, influence mortgage rates, but they're not the same. So just because the Fed changes its rate doesn't mean your mortgage rate will change by the same amount at the same time. So how are these two rates connected? When the Federal Reserve changes the federal funds rate, it affects the whole economy. If the Feds lower the rate, banks can borrow money cheaply. This usually makes it cheaper for banks to lend money to you and me. That means mortgage rates might also decrease, making it more affordable for people to buy homes or refinance their existing mortgages. On the other hand, when the Fed raises the federal funds rate, it becomes more expensive for banks to borrow money. This can lead to higher mortgage rates, making home loans more expensive. But it's important to remember that mortgage rates don't always align with the Fed rate. They're influenced by other factors too, like the bond market and the overall economy. When the economy is strong, mortgage rates tend to rise because there's more demand for loans. When the economy is weak, rates usually fall to encourage borrowing and spending. Inflation occurs when the prices of goods and services go up. When inflation is high, lenders charge a higher mortgage rates to ensure that the money they're getting back has the same value as the money they've lent. The bond market, which involves buying and selling loans or debt, plays a significant role in setting mortgage rates. When investors buy lots of bonds, mortgage rates can go down. And when they sell bonds, they can go up. Your credit score, the amount of your down payment, and the type of loan you choose can also affect your mortgage rate. Lenders offer better rates to people with solid credit history and who can make a larger down payment. So why does all this matter? When the Federal Reserve changes the Fed rate, it doesn't just affect banks and big companies, it also affects you and your family. If the Fed lowers rates, borrowing money for things like cars, credit cards, and homes can get cheaper, making it easier for families to afford big purchases. But if the Feds raise rates, everything from credit card payments to car loans can become more expensive, which can make people think twice before borrowing money. That's why understanding the difference between these rates is so important. It helps you see how big economic decisions can impact your everyday life. Understanding the differences between the federal funds rate and mortgage rates isn't just for adults buying homes right now. It's useful for anyone who wants to make a smart financial decision in the future. Knowing how these rates work can help you plan for big purchases like buying a home or a car or managing your savings and investments. And there you have it. The federal funds rate and the mortgage rates are closely connected but different. The Fed rate controls the cost of borrowing for banks, which influences the economy and ultimately mortgage rates. However, many factors can impact mortgage rates, so it's important to stay informed and work with a professional when you're ready to make financial decisions. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more financial insight, and share it with your friends and family who might benefit. If you have questions or want personalized advice, please comment below or contact us directly. Thank you for watching, and here's to making a smart financial decision for your future.